Hi, everyone. Good afternoon. Welcome to our panel, Developing Capital Markets, Financing the Future in Frontier and Emerging Market Countries. My name is John Schellhase. I'm an Associate Director at the Milken Institute Center for Financial Markets. And this is an issue that we care a lot about at the Milken Institute. We work on it year-round through partnerships with developing country government agencies and civil society organizations, where we work with them to conduct substantive roundtables to inform policy making processes. We also do original research on this topic, and something we'll come to a little later is we have a unique partnership with IFC to develop human capacity in these markets as well. This shouldn't be a mystery to anyone in the room why we care about this issue. Access to finance is one of the most important barriers that holds firms back from growth in developing countries, if not the #1 barrier in many countries. And so access to finance is therefore one of the constraints to economic development and economic growth in these countries, one of the most important ones. Likewise, governments often lack access to long-term capital to invest in infrastructure, healthcare, education, and other priorities for their countries. And so this panel has convened an excellent group of people to talk about how to catalyze investment into frontier and emerging market countries, as well as what governments and other stakeholders in those countries can do, should do, in order to both attract international capital and develop their local market participants and institutional investor bases. And I'm very happy with the group we've assembled. I'm going to let them introduce themselves. So just maybe 30 seconds each. We can start with Stephanie at the end, just who you are, your association, any relevant background you want to mention at the start.
Okay, so first, John, thank you very much. It's nice to be on the panel, and it's been a good conference so far. I am Stephanie von Friedeburg. I am the IFC COO. And relevant information, I've been in my job for 92 days, so we're almost at that 100-day mark.
Okay, great.
I'm Megan McDonald. I'm from Standard Bank Group, Head of Investment Banking. Standard Bank is the biggest bank in Africa by assets, and I've been involved in local currency and cross-border debt capital markets in Africa for about 17 years now.
My name is Claver Gatete. I'm the Minister of Infrastructure for 2.5 weeks now. Before that, I was the Minister of Finance and Economic Planning. Before that, I was the Governor of the Central Bank. I don't want to go on and on, but I'm happy to be here. Thank you.
Thank you, Master.
My name is Afsaneh Beschloss. I'm delighted to be here, John. Thank you very much for the introduction. I'm a founder of the Rock Creek Group, where we invest in emerging markets and frontier. And before that, I was at the Carlyle Group. And before that, I spent quite a long time at the World Bank investing in energy and being its Chief Investment Officer and Treasurer.
My name is Hedi Ben Mlouka. I am a founder and CIO of FIM Partner. We are an alternative asset manager. We invest solely in frontier and small emerging markets on behalf of endowments in the US, sovereigns and quasi-sovereigns in Europe, Middle East, and Asia.
Great, thank you, everyone. Minister, I'm going to turn to you first. Mm-hmm. And what I want to ask you is, as kind of a foundation for our conversation, is, out of the many priorities Rwanda could have pursued over the last year and several years, and did pursue, among those priorities that got heavy emphasis from you and your ministry was capital markets development. Mm-hmm. And I just wanted to ask, why was that one of your, and why did you spend so much resources working on that issue? We saw a regular issuance program developed. We saw you launch a commodities market that serves the region. We saw new issuances on the Rwanda Stock Exchange. And we saw you develop a 10-year guiding document called the Capital Market Master Plan. Why so much emphasis on capital markets development? Yeah,
thank you very much. Rwanda is a country that had a very terrible past. 1994, there was a genocide against the Tutsi, one of the ethnic groups in Rwanda. And after that, we developed a long-term strategy. We developed a vision we called Vision 2020. And what we needed was to reach a middle-income country by that time. And to reach there, we needed the private sector to be in the driver's seat, not the government. Because initially, the whole development process was dependent on the government investing. And the government was also dependent on how the donor resources were coming in to stabilize the foreign exchange, but at the same time, to drive the whole development. But that's not sustainable. We reached a point whereby the private sector needed to be the one investing more than the government. But the private sector was constrained because the banking system, which was supporting their investment, was also dependent on the deposits. It was the banking system, all the banks were not listed, all the banks were not rated. So you can imagine they were all dependent almost on the deposits from ordinary people. And for those deposits, they were short-term in nature, and so the banking system was also lending short-term. And that became a very big problem because the capital was very expensive. And for us to reach our goal, we had to say, well, we had to do something. We had to create the capital market to make sure that we can attract long-term resources, but at the same time, we can attract international capital coming in the country, and that's why we devoted our energy into developing the capital. So when we started, it was very easy for us because we wanted to say, well, who knows best about how to develop the capital market? So we picked on Stacey Warden, who is right here. And from there, from our time when she was in JP Morgan, and later on we met in the conferences, and we said, okay, let's just bring her back to Rwanda to see how she can help us. Indeed, you participated in also developing the capital market 10-year plan, which was very helpful because we wanted to become an international, really capital market that can attract others. So when we started like that, we said, well, we also have a problem of training of the capacity. I had to bring her back together with you and others, and I said, solve the problem, and you did. And then later on, we had the Milken Institute together with George Washington University and IFC coming together to sort out the problem of the capacity. And I think we are really, from this one, we started taking it on to see how we can develop our own capital market. And that helped that we should go another step further to go the region to see how our capital markets could be interlinked. Okay. And that way, then, we know that we can, from that point onwards, then we could be able to develop a competent capital market that can attract resources, not only for Rwanda, but also for the region. And this way, this is the only way we can sustain our development process going forward. And as a country as well, we had to issue a bond in 2013 that was oversubscribed 8.5 times. And that was our first one. And that gave us an idea on how we can work with the market going forward. But we needed also our market, our capital market, to be developed in a modern way. And then from there, we had to think of something bigger to change Rwanda, Kigali, into an international financial center. We visited many countries, including Singapore, we visited Jersey, we looked at other stock market, other financial hubs, and then we passed that policy that is going to establish a financial center. And again, to develop that, we have to be reaching out to some other people, I don't want to name names, for us to help us also achieve our objective. I think I can say that for now.
Excellent, thank you. And you touched on a few themes that I think we'll want to come back to: this international hub, the regional integration, et cetera. And I also thank you for pointing out that my boss is in the room, Stacey Warden. So, going from Rwanda, I want to take a wider step out to look at Africa as a continent. And I want to turn to Megan next to widen. I've heard you in the past talk about a two-speed Africa in terms of economic growth. Is there also two-speed Africa in terms of markets development? I would assume that there is.
Absolutely right. Thank you, John. And could we have slide number 1, please? And I just wanted to give you a broad snapshot, and don't fear, this is not going to turn into a long lecture and death by PowerPoint, but I thought it was useful just to give you an overview of, John, as you said, the two-speed Africa. So we generally see in Africa, you can see on the first slide, kind of 3, and when I talk about Africa, I'm mainly referring to sub-Saharan Africa. We kind of see the local currency markets dominated by 3 countries. So you'll see on the bottom right-hand side, South Africa with a local currency market of over $100 billion. The next biggest being Nigeria with $14 billion. And then the next biggest after that, it's kind of a close call between Kenya and Ghana with about $5 billion. We have fairly well functioning markets in some other countries in sub-Saharan Africa, Zambia, Mozambique, Botswana, Namibia, but they're all of a relatively very small size when compared to those major 3 countries. Can we have the next slide, please? In terms of Eurobond issuance, so this is cross-border issuance, we've seen a real growth in this market over the last 5 to 6 years, with about 14 African countries coming to the international capital markets to raise funding. The Minister obviously mentioned the highly successful transaction that Rwanda did. And when we look at volume of issuance, again, really dominated by South Africa and Nigeria in terms of annual issuances. We just recently closed the Nigeria bond issue earlier this year with an $11 billion order book, mainly made up of majority of investors from the US and Europe, including the UK. Next slide, please. This is just to give you a picture of, although issuance in Africa has generally been dominated by sovereigns, when one looks at international issuances, we have seen, and this is a recent development over the last 12 months really, the emergence of corporates coming to fund from Africa in the international capital markets. And you can see I've put up some of the logos there, but it kind of spans across sectors. So the typical companies you would expect to see in the resources sector, oil and gas, infrastructure, for example, mining companies, but we've also started to see some companies in the consumer space as well as in the telecoms and media space of a size and sophistication where they can actually successfully access international capital markets. Next slide, please. And this really speaks to some of the trends that I've really been talking about. So in the bottom left-hand side, these are the issuance volumes from a Eurobond perspective. So this is cross-border issuance out of sub-Saharan Africa. And you can see in 2017, highest levels of issuance on record exceeding $20 billion for the first time. And a lot of that being driven by issuance from corporates. Having said all of that, though, Africa still accounts for less than 5% of total emerging market volumes, and maybe that's a theme we'll come back to talk about later. Final slide, the next slide, please, is just really giving you a snapshot again of where does all this issuance come from. And you can see that it's starting to become more diversified, but the green and the blue lines represent Nigeria and South Africa in terms of dominating issuance. When you look at the bottom graph, and the top graph talks about sovereigns really accounting for about 60% of issuance, but we're seeing a growing trend of corporates coming to market. So maybe, John, I'll pause there.
Sure, but I do want to ask you, there are risks associated to going to the international markets. You want to talk a little bit about that and why local markets might also be an important area to
totally agree,
focus.
And I'm a passionate supporter of the development of local currency markets in Africa, because we've seen when we've had commodity cycles and when we've seen periods of sort of macroeconomic tension, you see volatility obviously in the dollar local currency exchange rates. And that's translated into high debt to GDP ratios for some countries in Africa that have issued a lot of debt in foreign currency. So for us, in terms of making Africa sustainable and making the growth of Africa sustainable, it's absolutely vital that local currency markets need to develop and grow. The challenge is that many of those local currency markets are dominated by sovereign issuance. So you have anywhere between 60% and 90% of local currency issuance coming from the sovereigns. We've just recently helped Ghana, and I think this is a very interesting kind of evidence of your comment about the importance of local currency markets. Since 2015, the Ghanaian government asked us to help them with local currency issuance. So local interest rates were incredibly high. They were having some challenges in terms of accessing international capital markets. And really what we've done for them, we've issued over $5 billion in local currency government bond instruments in Ghana. It's lengthened the yield curve, it's brought stability from an interest rate perspective, and actually brought the percentage of foreign currency debt down versus local currency debt, and created a much more sustainable debt profile for the government. And that's absolutely key in terms of the importance of local currency markets.
Yes. Excellent, thank you. Do you want to add something to that, Minister? Rwanda's had a similar experience of establishing a longer yield curve.
Actually, the point I wanted to add, which is very, very important, for countries like ours, normally you are dependent on foreign direct investment. in terms of companies coming to establish in our own countries. And that takes a long time. But if you have a capital market, in terms of the products which are on the market, it becomes much easier to attract foreign currency, which helps in terms of stabilizing the situation, the foreign exchange situation in the country. And this, we have seen it for us in our monetary policy management, where some of the resources that were coming from development partners were declining, but we could see that on the market, actually the resources that are coming from the capital market is also increasing. That way it stabilizes the foreign exchange market. And that's why I was saying this is very, very important for us to be able to reach out to the market, not necessarily from outside, but also developing our own stock market.
Right. Okay. Excellent. Expanding beyond Africa, I want to turn to Hedi and ask, your fund specializes on frontier markets and the secondary emerging markets. I want to ask, why you've gone so aggressively after that space, what you think is happening that's interesting there, and then also what your criteria are for entering new countries.
Sure. I think the most obvious answer for that is probably growth. When you think that 8 of 10 fastest growing economies are in the world are in frontier market, and many of them are actually in Africa. But I think the investment opportunity for us is beyond the growth. It's really about the transformation of these economies. And as long-term capital, what we're looking for is the structural gaps and secular themes which are really unique to frontier markets. These are themes of conversions and themes of transformation. Vietnam, for example, at the macro level is a very interesting example for that. We've seen economy which used to be state-controlled has been liberalized. Just last year in 2017, we've seen 74 state-owned enterprise being brought to auction, 5 times as much as 2016. We're seeing also, what Saudi is going through, very interesting in terms of liberalization of the capital market, but also the change at the societal level, on economic level, how privatization is accelerating, and several sectors such as education and healthcare are being privatized as well. So as long-term capital, what we're trying to achieve and what we're trying to capture is really these themes which are secular in nature and will take 10, 15 years to play out. We're talking about, for instance, healthcare spending. If you look across frontier markets, we're talking about average spending per capita of $16 per head. In emerging markets, it's closer to $40, and in developed markets, it's $700 per capita. So these are themes we like to invest in because we know that they're going to play out for many years. You look at organized retail versus unorganized retail in the frontier space. Organized retail still represents less than 10%. In emerging markets, 40%, and in developed markets, it's closer to 80, 90%. You look at insurance penetration, for instance, in a country like Saudi, which is a rich country, represents the premiums, insurance premium represent less than 1.5% of GDP. In developed world, it's like 6, 7%. So these are themes we like investing in. And I think what makes this space also more attractive for us as long-term investor is the fact that it's less competitive, to be frank. It's a space which is under-researched. For every stock listed in the exchange, you have 4 or 5 analysts typically following a stock, whereas in emerging markets, you have an average of 20, and in developed markets, a multiple of that again. So by being on the ground, having boots on the ground, understanding the culture, having developed our network of relationship with government officials, but also with consultants and companies, it gives us a very good edge in terms of sourcing opportunity for our institutional investors who want to have exposure to frontier markets. The last thing I would say in terms of why we like the frontier space is because we feel that we also can have a special relationship with the company you invest in. Many of them are family-owned. They know very well their business from an operational perspective, but they're not necessarily the most sophisticated in terms of creating shareholder value. So we engage with them in terms of how they can look at their balance sheet, how they can grow their business. We can put them in touch with other investee companies that we have, and we can help them improve their corporate governance, So we have that dialogue, which is, I think, extremely interesting, and makes us a little bit having a role of a constructive activist in the space. In terms of the criteria for investing, I mean, obviously, a theme that keeps coming back is liquidity. This is the biggest issue for frontier market and the smaller emerging market. And I mean, the trend is definitely going in the right direction, but it remains always the issue, especially for large global allocators to invest in frontier market, is how much money can you allocate and deploy in these markets? And when you need to exit, how do you exit when the liquidity is not great? The other issue, and I think which is always a challenge for us, is the consistency of regulation and policy making in this country. This is something that that is key for long-term investors. So you will see that you were mentioning earlier that you wanted long-term capital. The problem is that long-term capital is also wants consistent long-term policies and regulation, which is typically not there, unfortunately, in frontier markets. Some of the frontier markets, of course.
That's something I think we can maybe explore more. Afsaneh, I had a question for you, but I saw you smile so big when he mentioned liquidity. Not a happy smile, maybe. But so I wanted to maybe hear your thoughts on that theme first, and then I have another question for you as well.
I am with Hedi in terms of loving frontier markets, and I think as we talk about, all the portfolios are going towards lower cost and sort of index funds. The one place where you can't do that is frontier, and there's a lot of inefficiency, which means there's a lot of opportunity, which means there are potentials for higher return. As he said also, the liquidity is an issue, and certain markets in Africa, for example, trade on certain dates in certain ways, and very few investors hold the equities, let's say. So, so there is a big problem.
And how do you address that problem?
So I think I think the only thing that we do, and I'm sure Stephanie has much better ideas than I do on this, and IFC has been a leader in helping these capital markets progress, is if you have really good, let's say, broker dealers in these countries that are, are meeting certain standards. And if you can have, repatriation laws that are, because one thing is the liquidity and how much you can trade on a given market. Two is if you want to bring your money in or take it out, be able to do both of those things. So it sort of all goes in one package if you're an investor. And that's why sometimes you see people just investing in private markets, because the public market is effectively behaving like a private market.
Interesting. So to back up a little bit, I wanted to ask you. You told me recently that there's a kind of a one-time opportunity for these markets to leapfrog forward, and for investors to get regular returns while having incredible impact. And I wanted to ask you why you made that conclusion. What goes into that thinking?
In all my years of working on emerging markets, I have never been more excited in the sense that if you look at growth rates in emerging and frontier, obviously on a relative basis to developed markets, higher, at least double. If you look at where they're starting, the base, whether we're talking infrastructure, and I'm sure the minister knows a lot more about infrastructure than the rest of us. If we're talking about health sector that Hedi talked about, education, about anything that technology, anything that we are touching right now is getting disrupted, right? And what emerging markets showed, like with telecoms, is just the same way they leapfrog from not having phones at all, remember the landlines didn't work in Brazil and Latin America, elsewhere, and they jumped to cell phones. The same thing now with health sector. So for example, in the US, we have a big infrastructure of hospital beds where healthcare is moving a lot to getting people in and out, or moving to mobile, or moving to other forms of more efficient healthcare. Well, given that they don't have very much and they need to invest, they have the chance to jump ahead. With payment systems, we've seen, obviously the classic example is payment systems in China having, being 80 times bigger than the US. But in Africa, we're invested in some sort of new ventures in Africa that are very active in getting payments in a much more efficient way than here in the U.S.
Okay, great. We'll come back to some of those things,
you.
I'm sure. Stephanie, you've been so patient. I want to turn to you now. And you know, the IFC has been an incredibly important player in this space for a long time. And I've recently been hearing a lot about IFC 3.0. And I was wondering if you could introduce that concept to the room and tell us what it means for capital markets development.
Absolutely. So IFC 3.0 is IFC's new strategy. And 2 years ago, we had the fortune of celebrating our 60th anniversary. And if you actually look at our business sort of 2010 to 2016, it was really starting to plateau and flatten out. So we said to ourselves, okay, well, let's take a retrospective. And there are two places in IFC's history where you see massive growth in our business, and then it flattens out. So the question we asked ourselves is, okay, what's that next round of massive growth, and how do we make that happen? And we asked that question at exactly the same time as the Addis conversation, the billions to trillions, the STGs. And we said to ourselves, okay, this is really interesting. So let's create a strategy that has two pillars. The first one you've heard a lot about, which we call creating markets, the cascade. Well, historically, we've been a taker of projects. So sponsors come to us and say, we got this great idea, will you finance it? So what we said is, let's partner with our World Bank colleagues, let's go upstream, and let's start correcting the policy and regulatory environments that are hindering sectors and subsectors, and then create streams of projects from that. So great idea. Then you say to yourself, okay, we've created all these projects, but how are we going to finance them? So historically, we've thought a lot about how to use our own balance sheet, and then how do we fill the differential in the project with someone else's balance sheet. So we said, okay, well, maybe there's a different way for us to think about our own balance sheet and leverage our balance sheet. So mobilize more and more money. And we've done some really interesting things around how to crowd in some of the patient capital. So we have our AMC, which is our asset management company. We've got about $10 billion under management, largely from sovereign wealth funds. Then we created something called MCPP. First we did it for infrastructure, then we did it for manufacturing. Now we've done one for financial institutions. And it's bringing insurance companies and pension funds along beside our portfolio with the first loss. We got about $7 billion under management there. And then we said, okay, well, that's all really good, but that's not anywhere near enough. And what we really know is that we need deep, vibrant capital markets to make the kind of change that we want to make in the world. And if you think about what do we need for infrastructure and affordable housing, we need local currency financing, and we need long-term local currency financing. So we just finished a really interesting study with the World Bank, and what we proved is that if you had local currency financing, we could double the amount of private sector investment in infrastructure. So how are we going to do that? So I think we have three ways that we're tackling it. The first is we issue bonds in multiple currencies across the entire income spectrum. Why do we do that? Well, it diversifies our own funding sources, but maybe even more importantly in some interesting markets like Rwanda and Zambia. We have a AAA rated balance sheet. We're one of the last in the world. But we can actually create a risk-free benchmark. We can extend yield curves. We can create transparency in the market. So we're going to keep doing that. And if you look at our book of business this year, which is for our own account somewhere between 10 and 12 billion, 3 billion of that is going to be in local currency, all done through structured transactions and through swaps. So the second thing that we're going to do is push back into this notion of advisory. And you've heard a couple people talk about the policy and regulatory environment. And in the 1970s, IFC said capital markets are important, and we created this department. And we did some really incredible things. We built indices and worked with governments, and that whole group just sort of diffused into the organization. So we're actually putting it back together with the World Bank, and we're going to create something called JCAP, which is a Joint Capital Markets Initiative to do advisory work in places like West Africa, Morocco, Bangladesh, places where it really needs to be done. And then we're going to leverage something called the Creating Markets Advisory Window. So every year IFC sets aside a little bit of its own net income to do things that no one else will fund. So the Milken Fellows are going to be funded out of that Creating Markets window. And then thirdly, and I think actually most interestingly, is helping our clients begin to think about structured transactions. So we do, bond issues for clients for the first time. We do themed bonds. So how do we think about green bonds? How do we think about financial inclusion bonds? And we might be an anchor investor. We might credit enhance the transaction. And we're seeing a lot of interest in that. So in the last year and a half, we've doubled our book of business. We've gone from 3 billion to 6 billion in that space alone. So I think it's got huge opportunity, but it's concentrated in Turkey, Colombia, and India. So markets that are a little bit more advanced.
Okay, thanks. Thanks for taking us through that. Afsaneh, you have such a long history with the World Bank Group, former CIO, treasurer. I'm just curious what you think of the new approach, if you have any.
I think, you know, what Stephanie was talking about, I think, is really, really exciting. And she and Philippe and others, I think, in the IFC are really getting, you know, IFC has always been very cutting edge, but they're sort of putting it at a very different level. And I think the fact that they have the background they have in finance, in also technology that Stephanie has, but very importantly what she was talking about, which is putting the bank and the IFC together. It really, you know, many people have tried it, but the fact that the leadership has experience on both organizations and with many countries, I think is going to completely make this very different experience and much more successful. And, you know, I think this whole concept of doing well by doing good, it's going to be really, really exciting. You know, you asked earlier about ESG. I think what IFC is doing, what Stephanie was talking about, infrastructure needs in, you know, are huge, in, you know, several trillion a year in emerging markets. And if you don't have the kind of power that the IFC have, because IFC has capital put to work, but also talks in everybody who wants to put capital to work, whether it is through private sector or public sector, et cetera, is talking to the IFC and the bank. And then there's MIGA, and then there's, you know, other groups that are associated with all of that. At the end of the day, as she said, we also need private sector to really come in, as the minister said, also to really put in a lot of money, also local private sector. So it means looking at saving schemes. It doesn't mean just you know, getting private sector mutual funds in America to buy the bonds. It means local Rwandans and local Nigerians and local Chinese and local, you know, buying into this. And I think it's really one of those exceptional situations where the IFC can play a major role.
To that end, Megan, speaking of local currency, the importance of local currency markets, and also of the expanding importance of local institutional investors, that's a trend we've seen across the continent of Africa lately. The assets under management have been growing much more deep across the continent in terms of local institutional investors. Could you talk about how that's changing market development and any restrictions that are still placed on, you know, that might be holding some of that development back?
Sure. I mean, I think when we look at local currency markets, we kind of say there need to be three pillars, really, for them to be successful. You need the legal and the regulatory framework. You need the market infrastructure, which is kind of the whole ecosystem, a stock exchange for listing, a clearing and settlement system, banks to do market making from a liquidity perspective. Those are just some of the ecosystem requirements. And then the third component is the one you're speaking about, John, which is you need the institutional investor base. And in many of the countries in sub-Saharan Africa, you don't have a savings culture, you don't have actually any pension fund requirements. So that was kind of at the starting point, is to create legislation requiring everybody who's employed to start to contribute to a retirement scheme or a pension fund scheme. And what that has done, Nigeria in particular have done a great job in this, in that they've started to promulgate legislation aimed at developing that pension fund and savings industry, and it's had a direct correlation into the growth of the local currency market. So that just shows you how interlinked it is. So people worry about, you know, Minister spoke about, you know, having a stable macro environment, having long-term policy frameworks. Those are all absolutely important. But if you don't create the conditions that lead to the growth in your pension and your savings industry and your insurance industry, you lack a critical component that's needed to develop those local currency markets. And some other things that we've seen have been very interesting. We were fortunate to work with the IFC on the first bond that the IFC did in Zambia quite a few years ago now, called the Zambezi bond. And some of the interesting things that we found is when we looked at talking to pension funds, asset managers, we actually found that the legislation was so old that it didn't cater for investments by asset managers and pension funds into non-government securities. And that was quite a revelation for all of us, because asset managers said to us, but if I buy a government bond, you know, I don't have, look at my mandate, I don't have the ability to buy these so-called, it was classified as a corporate bond. So that's where capacity building that you spoke about is so important, because we worked with the IFC, you worked with the policymakers to actually explain that there needed to be some legislative changes just to create the simple thing of enabling an asset manager from a legal perspective to invest in a non-government bond. The other thing we found is that for an asset manager, once we'd created the capacity and the ability to invest in a non-government bond, we found that there were negative tax consequences. So the tax framework was very supportive of investing in government bonds and equities, but quite penal when it came to investing in corporate bonds. So the point of these kind of anecdotes is that in order for the local currency markets to work, we found you have to have a consistency of legislation and policy throughout that entire ecosystem. It doesn't help that you've got lower bond fees on your stock exchange if your tax framework is penalizing investors from issuing corporate bonds. So it's all linked together. And I think when organizations like the IFC come and do these bond issues, I think when we did the Zambezi bond, there hadn't been a corporate bond in Zambia for many, many years. And you then start to tackle all of these issues, and what that does is it spurs other issuers to come to market. So we actually saw, when there hadn't been corporate bond issuance in Zambia for many, many years prior to the Zambezi bond, a flurry of issuance post the issuance of that bond. So it's critically important, because that's another point we probably will discuss later, is the lack of supply, which is also hampering the development of local currency markets.
Let me go to the Minister. You wanted to say
Yeah, I just wanted, she's raising a very important point, because that's what we are facing ourselves. In order to develop the capital market, you need to develop the supply side, but also the demand side. And on the supply side, you are dependent on, for example, when you talk generally about the pension funds, we realize that 10% only are the people who are really on the pension fund. Those are the people who are getting regular salaries where they can deduct some money for pension. And then we put a scheme in place, which is the long-term savings, which also takes into account for those people who are not getting regular income, who are rural in nature, who are cooperatives, and so many others. So for those ones, they can save for their retirement, but also for the future kind of savings in that kind of long-term saving. It's a law by government, which means that it caters for all of them and how that money is being invested. Meaning they can save. You have to link it with the saving, but also the investment side. But by doing that, at the same time, you try now to educate all the Rwandans, the small companies, the medium companies, the large companies, the ordinary people, so that we can develop at least the retail market of that. So you have to do it concurrently. And at the same time, as we talked about I think we are talking about the disruption of technology, which you have seen, the more you develop these kind of instruments, you also see the demand on the other side. In the case, initially, when you are dependent on the banking system, we are encouraging the banks and the SMEs, and here I have one of my colleagues who was in the banking sector, we're encouraging them to go in the rural areas and expand, and also establish the savings and the credit cooperatives. And then we realized that actually, once they did that, they started creating what they call agency banking. You don't need a physical infrastructure, but you just needed any kind, any store, anything can be a bank. So that when we started working, then we forced the banking system saying, we need an infrastructure of the banking system, the core banking system. Actually, we were looking at the top 20 in the world, the Delta, the FlexCube, and so many others. And we were saying, you must have them, and you could instruct them because you're the central bank. After investing this one, we said, now you are right, this time we can use the cards, the Visa, the MasterCard, the China Union Pay, and others. And they say, well, we must have interoperability. We started doing all those things. By the time we finished, then there was the mobile payments. Right. The mobile payments took over almost those cards because people find it easier to be able to transact using the mobile phone. And now they are even asking how they can do the savings, how they can do everything using mobile phones. And they're also disrupting us as we do the regional market, because we are now becoming one market within the region. We are now intending to become a monetary union, and we're establishing, dealing with the issue of the capital market, because each of the countries wants to have its own capital market. And we cannot have consensus on having one for the whole region, but we decided that we should have all of them interlinked so that they have the common trading platform, so that we interlink the settlement system, the depository, and at the same time the payment system where the central banks talk to each other.
Can I ask you a question about this issue of regional financial markets integration? Yeah. One of Rwanda's strengths, I think, is that you're so agile. As a, in terms, you can do things quickly. You can do things. You can look at the best way to do something and then change, and you're very quick at doing that. As you link up with your regional partners, you end up linking up with people who are with countries that are a bit slower in how they do things, and there's a negotiation process. It becomes a bit tedious. How do you find, how do you navigate that tension between agility and scale?
Well, first of all, we don't have to wait until everybody is ready. Whoever is ready, we start the process so that others can see that it works. And once they see that it works and it has benefits, then they start coming on board. That's what, even within the East African Community Agreement, that's what is there. You don't need to wait for everybody. So that way you convince, you work together, but you don't have to wait for everybody to be ready. And that's what we are going for, and we believe this one, because it's a bigger market, and at the same time we have established the rules and regulations where we treat each other as one market, meaning that all the incentives provided by one country is the same as the other. And at the same time, at least all the countries now, they have capital account liberalization, so you can always move resources back and forth, and this attracts all the other investors from outside who are investing on any of the stock market. So it's working, it is slow, as you mentioned, but at least the best thing is make sure that it is perfect at the country level, and then slowly by slowly you move to the regional level, and this has worked for us. And the point I wanted to make is that as we are doing this also, we are seeing more demand from ordinary people on cross-border mobile payments, meaning that as much as we are putting the infrastructure in place and the settlement system in place and the payment system, people now want to see how this also can be done using a mobile phone, so that we can always trade, you can invest, you can do other things using a mobile phone. So that's a disruption, which is good, but at the same time, it's a challenge for regulators because they have to make sure that they have some kind of control into this process.
Great. Stephanie, I saw you nodding vigorously about this issue of the lack of, the supply of product. Yes. Could you want talk a little bit about that and how you see it?
Well, I was actually going to ask if I could step in because you and I talked about this on the phone when we first started to talk about the panel. I was actually running our telecom business when we did our first bond issuance in CFA. So Treasurer came to me and said, okay, Stephanie, I now have this CFA, figure out what to do with it. You know all the telecom operators. So for those of you that are bankers in the room, imagine going and knocking on the door of MTN or Celltel and saying, have I got a deal for you? I can give you 4.5-year money, CFA, but you can't prepay it, and you have to pay it back to me in a bullet, and all the other conditions so that we match funds, so that we don't actually run an open book. Very hard to do. So we've worked really hard in India to say, okay, how can we have a big enough pool of rupiah and create the project pipeline? So getting our investment staff to go out and think, oh, I could do this in local currency, right? So we could start matching those two things together. And in a country like India, we can. And about 90% of what we do in rupiah now. But in Africa, it's hard because we end up with local currency and then we have an exposure we have to figure out what to do with. So, changing the mindset of your investment staff to be thinking about how do I do this in local currency, and can we create a big enough pipeline so that we can, kind of find a symbiotic relationship between the bond issuances, the gathering of the local currency, and then matching those back to projects.
So that's the project we are discussing with IFC at that point, because we wanted to have at least investment in local currencies, especially for the East African regional currencies, so that you can have that kind of mixture until you have one currency for the region, where you can have a regional this time investing in one local currency, which is a regional currency. But in this case, that's why you have a convertibility process where the central bank keep each other's currencies, and this time you can be able to trade in any other currency without a problem, much easier, because the exchange rate convertibility becomes much easier.
Great. Hedi, I want to turn back to you, and you mentioned Saudi Arabia, and they've recently achieved emerging market status, secondary emerging market, if I'm correct. I wanted to hear you say a little bit more about what that means for the country, and also how did they get there, and what were the steps that they took for that achievement?
Sure. Well, they haven't achieved it as yet.
They're on the edge of it, right?
Yeah, that's right. I think Saudi is a very interesting case where it's obviously a wealthier country than the average frontier market. But at the same time, from a capital market perspective, it's not even classified as frontier, in fact, because it's not investable by foreigners, and that's the main criteria for inclusion into MSCI EM status. But I think the journey of Saudi is very interesting in the sense that they have done it in record time. They've opened up their markets to international investors. They created first QFI status for qualified financial investors, and then they have allowed investors to come into the market. They've also changed the regulation and how the market works, brought it to global standards. When we're talking about settlement cycles, it used to be T+0, which is not workable for international investors, came to T+2. They have improved everything which is around governance and information availability. And today they are on the verge of being included in MSCI EM. What that means is that, first of all, a wall of dollars coming into the market, because just by the fact that you're included into MSCI EM, there is passive money that comes to you. In the case of Saudi Arabia, we're talking about $12 billion. It comes into to the equity markets, and then active money of probably triple that. So we're talking somewhere between 35 and $45 billion that will come to the market. And that's for market capitalization of $440 billion and a free float of $240 billion. So it's very meaningful. What it means for Saudi, I think, is that it will improve pricing discovery in the market, and it will bring sophistication to the market, and therefore better allocation of capital in the economy. And this is what capital markets do, and I think it's not just about the money or the capital itself, but also the fact that you will have a better allocation of resources in the economy. I think that's very key. So beyond that, I think the interesting case of Saudi is about the transformation of the economy. This is an economy, this is a government that wants to decouple the economy from oil revenues. So they have targets by 2020 to bring government revenues from 165 billion Saudi riyal to 560 from non-oil revenues. So that's 18% of GDP, so extremely meaningful. But there's also a lot of a change in terms of privatization of the economy. They want to bring, for example, private healthcare to represent more 35% versus public healthcare. All of these themes, I think, are extremely interesting, and I think it's a very powerful case study for other frontier markets. Although it's obviously Saudi has different challenges from the average frontier market, I think it's the resolve that we have seen in terms of bringing their capital market standards into global market standards in a record time is extremely interesting, and could be a case study for other frontier markets.
Afsaneh, going back to your moment of opportunity, your excitement, yes. You've never been more excited. What should countries be doing to capitalize on that excitement in this kind of moment to make sure that we don't miss it?
So, we've touched on a couple of investment themes. Infrastructure, obviously a lot of infrastructure is going to be built in the next 20 years in emerging markets. They're growing very fast, which means that the largest growth in energy use will be in emerging markets. The largest cities are going to get even larger, and most of the new mega cities will be in emerging markets. Mobility is changing. I don't need to go into that. Everybody knows more about that subject than myself. So everything that we're talking about, payment systems we talked about, basically this is an opportunity where emerging markets can bring in, the big theme that we use, ESG and impact. In fact, they will have to use more efficient energy. They will have to use cleaner energy. They've learned the lessons. Even in China, where we're seeing, the marginal growth in energy right now is not in coal. they're scrapping a lot of the coal plants, the plans of new plants, and a lot of the new plants are for natural gas even, and gas not perfect, but better than coal. Solar and wind and other forms of energy are really, really fast growing in emerging markets. So on a relative basis, whether you look at some projects in Morocco that have been completed or elsewhere in emerging markets, I think everything that we're touching, infrastructure will be built differently. Yeah. Roads will be built differently. Transport will be, mobility is not going to be the same as we are, using today. And so everything will have an opportunity, I say, to be more efficient. And that is where I think this sort of, again, going back to the role of the bank and the IFC and the private investors is really, really important, because a lot of people are talking about impact investing, but at the same time not really translating it into actually putting money to it. And I think this will be the biggest opportunity, really, in the next 10 years. So.
Fantastic. Well, I want to leave a little bit of time for questions. Before I did that, and this is something I was hoping we'd get into more, but I guess we're going to run out a little bit of time. One of the things that we could have really done a deep dive on is the importance of human capital, both on the investor side for your teams, but also for your teams and the government. And I wanted to just let Stephanie have just a bit of time to talk about how the IFC and the Milken Institute are partnering to develop the next generation of talent in some of these markets through our Capital Markets program.
Thank you, John. You've probably heard at different points during the conference reference to our Milken Fellows program. Thanks to really to the credit of our treasurer, Jing Donghua, who really knew that we needed to develop human capital in this area at the sort of mid-career level in different governments, specifically in Africa. He wanted to create a program, and he knew he couldn't do it himself. And so he came to Mike and said, Mike, how do we do this? And so we have created a program. We've sent roughly 40 students through it, where they spend 4 months at GW in an intensive program. And we have, very different kinds of people who teach. I was at dinner last night with one of the professors who said to me, I love the Socratic method. And the amount of interaction that she was getting from the students in the room was really enthusiastic. She couldn't have been more complimentary about how eager our Milken Fellows were to learn. And then, again, leveraging Mike's network, then we take the fellows and we put them into institutions for another 4 months. So they actually get practical experience looking at and rolling up their sleeves and saying, okay, this is what I learned and this is how you actually apply it. Then we send them back to their countries. They're all networked together, and I think as the network gets bigger and bigger, they'll be able to call one another and say, listen, I have this problem, how would you solve it? I'm interested in doing this, how do I call someone else in? So it's a really powerful program. I think there's probably some Milken Fellows in the room. Are there any Milken Fellows?
If you guys could stand up, we'd love to acknowledge you. So these are the rising stars in ministries of finance, central banks, securities regulators, and other agencies who are going to be building these markets, and one day going to be sitting in this chair here on these panels. So I do want to open it up to questions, and if the fellows have any questions, I'll go to them first. We can collect a couple. We can start here at the end.
Yes, good day.
Could you stand up and introduce yourself as well?
Okay. My name is Eden Mabilana. I work at the Central Bank of Mozambique. I have a question for Afsaneh and also Megan. Afsaneh touched a little bit on liquidity for capital markets development, which in my personal opinion, is the holy grail of capital markets development. So one of the things, one of the factors that you pointed is the good broker-dealers in order to advance through the liquidity, and also rules. I will speak on my perspective from Mozambique. I think we have good rules. I think Standard Bank is one of our players. I consider them a good broker-dealer. But still, our market is not liquid. So, in your opinion, Afsaneh, what do you think that we should do in order to get more broker-dealers, which are good for the development of our capital markets? And also, Megan, you are one of the players in the Mozambique market. In your opinion, what should we do in order to get more broker-dealers on board? Thank you.
Okay, great. I'd like to collect any other questions before we dive into that one. Yes.
Hi, my name is Leah Kusensela, and I'm from Zambia, SEC. And my question, anyone can take it. What insights or advice can you give on how we can involve more of the informal sector? As you may be aware that in emerging markets, in my country particularly, we have such a huge informal sector that can be tapped into to help pool savings. So what insights can you give or advice on how we can tap more into the informal sector?
Okay, great. And we can do one more if there's...
Can answer that.
Yes, and we'll come to Zain. And unfortunately, this is all we have time for.
Hi, my name is Zain. I'm from Central Bank of Mauritania, and my question is for the minister. I was to ask him what have you done to bring the private sector to invest in infrastructure when, for example, in my country, private sector is more relying on the government investment to jump in and to be part of the deal.
Great. Okay, thanks. So, Afsaneh, liquidity.
So very quickly, while we're complaining about liquidity in these markets, let's just go back like 5 years. Let's go back 10 years. So if we look sort of historically, for those of us who've been involved in these markets for a long time, obviously there is more action and the markets are bigger and the liquidity is a lot better than it was 5 or 10 years ago. So number one. Number two, how do you get more liquidity? By more people involved in the markets, more people buying, more people selling, and then having, as you said, broker-dealers who are honest and reliable and the right legal framework, as Megan suggested, and a lot of other good things that she suggested. So how do you do that? Again, more activity in the capital markets comes with some of the things we heard about. Confidence in the markets, confidence that there's not a lot of insider issues, confidence in transparency of the markets. And one of the things Stephanie and I have talked about is IFC has also been involved in sort of looking at across broker-dealers and helping to provide standards. And it's one of the things, in fact, we were literally talking about last week. And they have a really important role that could be very helpful.
Megan, what do you want to add on that?
Yeah, I think it's a great question. I've been in this market 17 years, and liquidity is the old chestnut. It's something that I heard about probably on my first day in the job, and 17 years later, we're still talking about it. To the question about I think broker-dealers and having entities that will make a market is incredibly important. I think two things. What would you do to encourage broker-dealers? One is the lack of information. So the problem is, how do you price these instruments in the secondary market? And we all tend to have that herd mentality. When there's risk in the system, everybody wants to sell their bonds back to the broker-dealer at par. The broker-dealer doesn't want to trade at par. And the problem is you have no transparent market mechanism of price discovery that tells you what the price should be. And this is all a bit of a vicious circle, because why don't you have a kind of an identifiable market price? Well, probably because the instrument traded last 3 years ago. So it's all kind of it's all interlinked. And I think one of the things, and I've been pushing it for in my own organization, is you actually have to play a part as a responsible citizen, let's say, a corporate citizen in these markets, is you need to set aside a certain amount of your balance sheet to say, we're going to support and we may have to take losses. But the second thing, I think, is education, is to help people who are trading in the market understand you cannot always trade these instruments at par. And that then comes back to the price discovery mechanism, which I think will help a lot of these issues. At the heart of it, though, I think, is a lack of supply. Because the challenge with all of this is that investors tend to be buy and hold because they don't see many of these instruments coming to market. And all the things we spoke about creating a market that's conducive to supply, really come into play, and they're critically linked to the liquidity issue.
Okay, thank you. Minister, I think you wanted to address both the formalizing the informal, and the question directed to you specifically, bringing private sector to the infrastructure investment.
Yeah, thank you very much. The first one really involving the informal sector, I think was asked by someone from Zambia. Yes. We also have a very large informal sector, which really is not on the market. And what we did was, normally for the savings, since all of them cannot participate on the market in the normal way, we had to create the Rwanda National Investment Trust, which is a collective investment scheme that allows the resources from any amount, starting from the very, very small ones, so that this trust can be able to invest on your behalf and give you a return. And this is part also of the savings. And this one is working very well. It's moving very fast. The issue of infrastructure. Infrastructure is so large. I realized it when I became Minister of Infrastructure myself. It's so big. It is so big that you start from airports, airlines, water, energy, transport, roads, everything, any kind of infrastructure. But if I can just give you an example of energy, we used to finance all the energy in the country as government. And later on, we decided that we can have actually the private sector tap into it. What we did was we actually allowed the the private sector to do the generation, and then we guarantee that we'll buy everything they produce on an agreed price. That's why they have the PPA, the Power Purchase Agreement. And once you have that, and it is guaranteed by the government, you are assured that anything that you produce will be purchased at a certain price. And that's why we are having so many companies that are coming on board, including the one seated here, Paul Hinks, who is coming to produce 81 megawatts of energy from methane gas. So he can tell you more about that. We have another one investing also in methane gas. We have a Turkish company investing in P2 power, and so many others, including those in the micro hydro and others that are in solar. Those ones we guarantee the purchase, but not only the government purchasing, but also we put a scheme in place so that the people can be able to sell their energy and be able to get a return. And then they are assured for that. So we also assist in so many ways, but at least we have encouraged the private sector to be able to come to that. And that is also happening in other areas.
And unfortunately, we have to stop there. We are out of time. I want to thank all of our panelists for joining us and sharing your insights with us, and for such a great panel. Thank you very much.
Thank you, John.